Now, tonight's agenda is, like I say, it's all about the Elliot Wave theory. Now, this is part one on the Elliot Wave theory. I will be doing a part two in future webinars. But anyway, today we'll be doing part one. And like I say, first of all, we'll be covering what is the Elliot Wave theory. Second, we'll be doing what is impulse waves, which is part of the Elliot Wave theory. Then we'll be talking a little bit about corrective waves. Then the rules of the Elliot Wave theory, the rules you have to follow for the theory to actually work. And then we're doing a few examples, then future educational events, and of course the usual question and answer session. And there you go, let me put myself on. Hey, hello everyone, good to see you all. Okay, so what is the Elliot Wave theory? Bit of itchy nose there, sorry. Right, the Elliot Wave theory. Now the Elliot Wave theory was developed in the 1920s by, surprise, wait for it, a man called Ralph Nelson Elliot. Very incredibly creative name. The theory is based upon the belief that the stock market is driven by repetitive cycles, not by chaos. Elliot believed, whenever I say Elliot, I always think of E.T., I don't know about you. Elliot believed that these, Elliot believed that these market cycles were created by traders' reactions to the psychology of the masses. The upward or downward movements in the market he called waves, and he believed if you could recognize these waves, you could predict where the market will go next or might not go next. Now, these so-called waves can be split into two categories: impulse waves and corrective waves. Now, impulse waves, Mr. Elliot proposed that the market was in, when the market was in a trend, it moved in like a 5-to-3 wave pattern. The first 5 waves were called impulse waves. In this pattern, the impulse waves we're talking about, wave 1, wave 3, and wave 5 would go where the overall trend was heading. But wave 2 and wave 4 were corrective. So a little bit like this. Now wave 1, this is where the market initially moves upwards. Okay, this is driven by a small number of people who are buying into an asset. They believe the price is low and it's a good time to buy in. This, obviously, when you've got people beginning to buy something, causes the price of the asset to rise. That's wave 1. Wave 2 is basically enough people, or the original people who bought in, now consider it overvalued and they secure their profits. So they start to close their positions. And obviously this causes the price to drop below, and this sort of drops a small little wave drop downwards before the market sees the ideal price to start buying in again. So that's wave 2. Wave 3 is usually the longest and strongest wave. The asset at this point has caught the imagination of the masses and it causes the price to surge. And like I say, wave 3 usually exceeds the high first hit by wave 1. So there's wave 1, wave 2, and wave 3. As you can tell, is a lot bigger wave. It's where the price really starts to surge and the masses start to jump in and buy in. Wave 4, let's get to it. Here we go. Wave 4, at this stage, the traders lock in their profits. It's now they consider the assets to be too expensive. This causes the price to drop again, but it's a weak sell-off. Okay, so it's not a strong drop. It's a weak sell-off because there's still a good number of bulls in the market, which leads us to wave 5. Now this level is basically driven by mass hysteria. Okay, and it's the last number of bulls rush into the market, really based on the fear of missing out. You know, they look for any reasons or any explanations to why to buy that asset, and they rush in. This is a sort of time like when you see, for example, magazines with the CEO of the stock of the company whose stock is, you know, on wave 5 in the newspaper, or you see headlines like Bitcoin did last year. We start seeing it on the BBC, the Sun newspaper. This is wave 5 because it pushes the price higher once again, but because it's driven by hysteria, okay, the asset really does become overpriced. And then the market prepares for the sell-off, which then leads to the next stage, which is the corrective waves, also known as the ABC pattern. Corrective waves, ABC. So here's our Elliott wave, our 5 impulse waves. Corrective waves, or ABC waves, are like this. This is when basically the hysteria of that asset has ended. Okay, the market starts coming back to its senses again, starts controlling its emotions again. And it is really the beginning of the reversal of that trend. So wave A is the initial sell-off. Wave B, this is the case when there's just a small number of bulls still left in the market who believes in the asset, and they jump in, but there's not enough of them. So wave B is a slight jump up when they buy in again, because they're not enough of them, because by this point wave C then kicks in. This is where the bears really take over, pushing the asset further downwards. Now there's 3 rules to follow when you're looking for the Elliott wave theory. Rule 1 is wave 3 should never be the shortest impulse wave. Wave 2 should never fall beyond the start of wave 1. And rule 3, wave 4 should never go to the same level as wave 1. It's a good thing I can say wave, isn't it? My accent is a little bit there. So let's give some examples of live, on the charts we've seen of these Elliott waves. So the first one I found is the Amazon. Okay, Amazon. It's the Amazon pattern. This is on a daily. Okay. So have a look at this, and straight away I can see there's wave 1. The market initially starts to buy in. Wave 2, remember the rule, doesn't drop below wave 1. Wave 2 happens, and the initial people buy in, starts to sell in, take profit, which then obviously then leads to wave 3. Remember the rule, wave 3 is always got to be bigger, always got to be the longest impulse wave. So wave 3 then kicks in, pushing the asset, in this case the Amazon stock, higher till obviously the initial people who jumped in sell off and start taking some profit, creating wave 4. And finally, the last remaining people of hysteria, seeing the record levels or whatever, the hysteria of the price, buy in, pushing the stock higher, which is wave 5. We then have our corrective waves. We have a wave A, as the market starts to sell off. The last remaining bulls buy in, making wave B, before obviously the trend, wave C kicks in, the bears take over and sell off the stock. So there we can see it there. Wave 1, wave 2, wave 3, wave 4, wave 5, and wave A, B, and C, the corrective waves. Now, another example is even clearer. And this is WTI oil. I was watching this a little time back before obviously, sorry, a little thirsty. Watching this back before, obviously it's gone on a bit of a bull run. So here's WTI oil. Wave 1, nice clear image there. Wave 2, as the market starts to sell off, initial people bought in, take profit. This leads to a big one. Wave 3, remember the rule, wave 3 is always got to be the biggest, longest impulse wave. Clearly it is, pushing the price higher. Then wave 4, as people consider it overpriced and start to sell off. And then finally wave 5, the last remaining bulls jump in, fear of missing out, hysteria. Remember around this time, of course, obviously oil was in the headlines again, pushed it up higher before, of course, the corrective wave kicks in with wave A, it's a sell-off. Wave B, the last-ditch effort of people trying to keep the momentum upwards before obviously then going to wave C. So, those are 2 examples of Elliott waves in practice. And these charts, like I say, I've done today. And like I say, the WTI one in particular, you can really see the Elliott wave theory in play there. The reason why people try and use, obviously, Elliott wave theory is to try and identify what wave that asset is on and whether or not they can feel whether or not wave 3 is about to start, or wave 4 or wave 5. Ideally, obviously, in the ideal world, you would be watching the pattern here. And if you saw it here and you were confident enough and your fundamentals and your belief based in it, you could believe that actually maybe we're about to start wave 3. And of course, potentially could be a good trade.